People keep asking me the same thing over and over again. Is the housing market about to crash? They hear all the gloom and doom talk, but the data may say something different. Let's dive right into that. Here's some reasons why the market isn't poised for a crash. Let's address the conversation of foreclosures. I've been hearing a lot about this. Both we're not going to see a significant increase in foreclosures, and we are poised to see a significant increase in foreclosures. But at the end of the day, the data supports that foreclosures are still at pre-pandemic levels. Back in 2008, foreclosures were everywhere. We all know that. We've been talking about that on this channel, and there's plenty of channels talking about that. The reason is because banks were willing to make risky loans, and they were loaning over 100%. Pretty much if you had a pulse, you could get a loan. That is a risky maneuver. Now, we fast forward to today, it's a lot more difficult to actually get a loan and get approved for a loan. So let's look at this chart with foreclosure rates. As you can see, foreclosures are still down. In Q4 of 2024, that's the end of the year, we're at the beginning in Q1 of 2025 right now. You can see foreclosure rates are still down and bankruptcy rates are still down. In fact, if you look at this data point from the Pinellas County stats, just in Pinellas County alone, I could do a clickbait. And if you look at this chart, you could see that foreclosure REO sales are up 500%. But that's January of 2025, 6 properties closed. That's compared to 1 in January of 2024. So you understand how many houses actually closed. We had about 700 closings in January of 2025 for this year. And back in January of 2024, we had 571. So that's a 22.6% increase roughly on closed single family homes in Pinellas County. So you can see we can manipulate stats and data to go either way. This is why I like to show the data so you can understand and make the most informed decisions. And I do encourage you to watch the other channels that talk about the pending foreclosure. They have different perspectives. And then you can do all your research and make an informed decision. Touching back on the lending standards that we already mentioned briefly, lending standards have become much more strict today than they were back in 2008. We don't want to repeat the same thing over and over again. Remember those no income, no doc loans? Those are a thing of the past. That's where people got into trouble. Banks were also handing out loans to people with shaky credit at best. Today, mortgages are going to a majority of people with a score of 720 or better. Now, does that mean if you don't have a 720 credit score, you can't get a loan? Absolutely not. They have good jobs. Maybe they just had a few late payments, or perhaps, everybody gets a bump in the road. Let's take a look at this chart. You can see that the teal is a majority of the people with 760 and above credit scores. You go down to the gray and you're at 720 to 759 and so on and so forth. Basically what this means is you can see a majority of people have good, strong credit, which is leading towards a relatively healthy economy. Now, I know the economy is a hot topic right now, and we do have a lot of instability. There's some concerns with jobs, but overall, with excluding inflation and all that, right now we're just talking about mortgages. And here's why I say that we're more stable in the housing market. Homeowners have way more equity than they had back in 2008. Back then, you could put almost zero money down and finance, like I said, 110%. It was almost like free money. When prices dropped and the economy crashed, there was no room to fall back. There was nothing. You had no equity in your home because you had financed, 98%, 100%, 110% in some cases. So if you did go into foreclosure and like a lot of people, they lost their jobs, got relocated, there was no cushion room, which ended up leading to foreclosure. Let's talk about inventory for a second. Inventory is on the rise, and it's definitely taking longer to sell your home, which is adding to the inventory increase. They're sitting on the market longer. Gone are the days of you selling your home in three days, 1 week, 2 weeks. Yes, there are the unicorns that do get sold quickly. A well-priced home in great condition in a good neighborhood will probably sell quickly. And I can cite examples of that all over the Tampa Bay area. But overall, we're getting back to pre-pandemic days on market. Right now, Pinellas County is roughly at an average of anywhere between 30 and 60 days on market. And I know that seems like a wide spread, but I'm trying to incorporate certain areas. So we have micro markets within the Tampa Bay area, and it's best to reach out to someone and ask what your average days on market is. This is a good way if you're going to list your house to gauge how long it's going to be on the market, because you may have purchased when houses were flying off the shelves, basically. So that's your experience with it, and that's what you've seen. So it's understandable that you see things sell quickly. Those days have changed. So getting an understanding of what the average days on market for your specific area and your neighborhood is extremely important. If you'd like to talk about the Tampa Bay area or your specific area, please feel free to drop a comment down below or reach out to my contact information that's in the description. I'd love to chat with you about it. And if you're outside of my market and you need some specific information, I'd be happy to send you out to one of my partners that could address your specific market so you could get the data that you need. Leave me a comment. Feel free to send me an email or just give me a call. Okay, back to inventory. It's completely understandable that you're going to go on to Zillow, Realtor.com, anything, and you're going to look at homes that sold in your neighborhood. It makes sense. And you're going to see in certain circumstances where the prices 6 months ago, a year ago, 2 years ago, your neighbor sold for a higher price than what's actually happening now. The reason for that, if everybody remembers during the pandemic and that buying frenzy, people were overpaying for their homes. So that's also adding to a few things on the selling side. I've talked to a lot of customers now that are considering moving, or they have to relocate back to where they used to work because they were called into the office or they took a promotion, etc., and they have to list their house. But they purchased during the peak, and they're kind of in an upside down position because while they paid, the bank did not finance the additional cost for the home, the person came out of pocket, and money gone is money gone. So they are in a predicament and they are trying to recover or at least break even. That's why you're starting to see some of these prices a little bit higher, and then they're starting to bring prices back down. Selling prices don't necessarily equal equity. Over the last year, we've gained about 2.5% nationally on average equity in homes. So you can see, yes, there's some areas that went high, some areas that went low, but on the average over the last 12 months, we've had a 2.5% increase. Sometimes when you see these price reductions, that's a price reduction because they started off the listing a little too high. They were in an aspirational pricing, or they negotiated, they came down, but their house could have appraised for more than what they purchased it for. I actually just had one about 6 months ago. The house actually appraised for more than what the contract was for. That person actually had some equity built into their property above and beyond what they already put down. And that's a good thing. We want to see that. We're starting to get back to a normal market. Again, all positive signs. Let me give you an example of somebody listing the house at an aspirational price, and it's just here in my neighborhood. We had a house, great shape, new roof, paint was done up nice, everything looks fantastic, but they were about $100,000 over the highest price home that sold in this neighborhood. To be fair, we don't have a lot of sales in this neighborhood. Everybody kind of sticks around for a long time, but they're about $100,000, and that's how sat for about 6 months. And then they had open house after open house, and there was just no interest because the house was too expensive. And in my area, you're also competing against new construction. That's a whole separate video. Fast forward 6 months, the new realtor came in. They have priced the house more appropriately, and they're in line with market value now. So hopefully they'll get that house sold soon. Another thing we need to look at is what's called the lock-in effect. And that's basically where people's interest rates are locking them into their home for one reason or another. We could do an entire video on the lock-in effect in the inventory, but I'll keep it simple here. In general, people are staying in their houses longer. On average, people would stay in their house roughly 6 to 7 years. Now it's starting to, projection-wise, it's starting to go up. It went to 10, 11, and even 12 years now. It's getting longer and longer. So we'll see what actually shakes out a few years down the road. So we'll have to stay tuned for that one. According to a recent report by Redfin, 17.2% of people have a mortgage rate over 6%. That means a staggering 82.8% of people with a mortgage are under 6%. And I think as of the recording today, we're at around 7% interest rates, which obviously is going to vary depending on your credit worthiness and other factors. But that is adding to the lock-in. Why would people move if they are below 6%, 5%, 4%? They're going to stay in their home. Yes, people will still move. It doesn't mean that listings aren't going up, because listings are going up. We have a lot more listings. We just talked about that. But people are generally going to stay in their homes a lot longer. Something else that's contributing to this non-crash. Remember when I spoke about foreclosures and how they were short? We had 6 that closed in January for Pinellas County, 6 compared to 1 last year, a 500% increase. Well, let's look at the equity that people have in their homes. According to a report by Axios in December of 2023, 39.3% of Americans are mortgage free. That's insane. This is a good thing. 39.3% of Americans have no mortgage, which means if they're going to sell, they're not affected by interest rates because they can take the equity that they have in their house and purchase pretty much for cash, most likely, the next property. Also, let's say those people fall into some dire straits. They've got that cushion. They have equity in their home that they can do a refi because you have that asset. And don't forget, people have a lot of equity built into their homes already. Remember, back in 2010, 23% of homes were underwater. Today, it's only 1.8%. Let's look at this chart too. Loan to value ratios have plummeted. And in this instance, plummeting is a good thing. Having a low loan to value ratio means the loan amount to the value of the home is less. So it means you have more equity in your home and less loan. That means you have a cushion. Again, going back to the fact that if something happens, people have a cushion. It's all showing a strong housing market. Now, we can talk about new inventory along with lock-in effect. If you want to see that video, drop a comment below and I will make that video for you for sure. But let me know what you think. I want your opinion on this. So what's this mean for you? The market may shift, but we're certainly not going to go back to a 2008 market crash again. I would fully expect to see some numbers come down slightly a little bit this year, but I also think that as everything stabilizes after the election and the economy gets a little bit more stable, inflation comes down a little bit, it becomes more stable, things will get better and the housing market will continue to grow here in the United States and locally in the Tampa Bay area. But if you're waiting for some sort of a massive market crash before buying a house, you might be waiting for a long time. An example would be, customers that I spoke to during the pandemic when it just started. I get it right in the beginning, people were a little scared, but once those interest rates started hitting like 2%, home prices hadn't gone super high yet. I had one customer that purchased a home in 2020 actually, and then they just sold it in 2023 for a $40,000 profit. They got married, they expanded, had kids, so they had to sell the house and upgrade. And I was privileged enough to be able to help them out with that situation. And they turned a profit at the end of the day, net about $40,000. So that's today's video. If you've got any questions, please feel free to reach out. I'd love to chat with you. My contact information is in the comment below and over in the notes section. Thanks for watching. I'll see you on the next video.